The following program is paid for by Absolute Mortgage, a division of Finance of America Mortgage LLC, Equal Housing Lender, NMLS 1071, AZBK 0910184. Tina Mitchell, MLO 145420, is a licensed loan originator with Absolute Mortgage. Visit AbsoluteLoans.com or call 888-90-HOMES for cost information. You're listening to The Money Hour with your host, Tina Mitchell, sponsored by Absolute Mortgage, a division of Finance of America Mortgage. Now, in the studio, local mortgage and finance expert, Tina Mitchell.
Welcome to the Money Hour on 11:50 a.m. KKNW, the Saturday, December 26th show. I am your host and mortgage expert, Tina Mitchell. I've built a network of elite industry professionals every week sharing their knowledge and expertise to my listeners. I hope all of you are enjoying your holidays and getting ready for the new year. It is almost 2016. How exciting. If you're hearing my show at a different time or day, you are listening to a rebroadcast, but I'm here to answer any questions or connect you with the guest I have on the show. Please call the show at 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com. And the lineup for the show today, we have Mathew Gardner, Chief Economist with Windermere Services. Where's the housing market going in 2016? That's a conversation I'll have with Mathew today. Also, I have Tyler Freed with Windermere Real Estate. We're going to talk about today's real estate market. And last guest in studio is Christopher Orr with Pensco Trust, investing in real estate with your retirement dollars. So it'll be an interesting conversation with Christopher. Great information and great guest in studio today. For more information or topics discussed or topic discussions that you'd like me to bring into studio, please call the show. 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com. And we'll start at the show with a little money chat.
Money.
I have some great news to share. I'm going to talk about my arena. I'm also going to talk about your CPA's arena. We're going to bring back the great news with mortgage insurance tax deduction coming back. Thanks to the Tax Relief and Healthcare Act of 2006 and the Mortgage Forgiveness Debt Relief Act of 2007, mortgage insurance premiums were tax deductible and treated the same as mortgage interest. We lost this benefit, but on December 18th, 2015, the president signed legislation that renews the tax deduction of mortgage insurance premiums for qualified borrowers through 2016. So the deduction is effective for purchase and refinance loans closed after December 31st, 2014. Mortgage insurance premiums paid accrued after December 31st of 2016 may qualify for a tax deductible for homeowners' federal tax returns. Now, lender mortgage insurance, also known as private mortgage insurance or PMI, in the U.S. is insurance payable to the lender or trustees for a pool of securities that may be required when taking out a mortgage loan. It is insurance to offset losses in case you, the consumer, is not able to repay the loan and the lender is not able to recover its cost after foreclosure and the sale of the mortgage property. So PMI is required on conventional loans with less than a 20% down payment. Borrowers with adjusted gross incomes below $100,000 may deduct 100% of the MI premiums. Now, I do want to disclose I'm not a licensed CPA. I'm a licensed mortgage professional. So you do want to consult with a professional. For borrowers with adjusted gross income from $100,000 and a penny to $110,000, deductions are phased out at 10% increments from each additional $1,000 of adjusted gross household income. Now, the homeownership deduction, it's huge. You can write off, as you most likely know, your interest on your mortgage, your property taxes, and now, just as I've mentioned, the PMI or the mortgage insurance as well. So let's take a look at how this looks. On a $400,000 loan, the deduction estimated, let's just say $25,000 for the year. If you were in a 25% tax bracket, this would be $6,250 less in income taxes you would pay as a homeowner with these deductions. Now, if you amend your W-4 with your employer and increase your withholdings, you can see the benefit in your income every month. You do want to consult with a licensed CPA to make sure that you're amending correctly and you're not having to owe money back at the end of the year. The idea is to break even. Now, the benefit is this is real cash and it's real money. It's just whether you choose to realize the benefit at the end of the year in less income taxes that you pay or upfront every month in your take-home income. Personally, myself, I want to see it upfront my take-home income because I don't want the government collecting interest on my money. I want to be able to realize that benefit myself and do what I can with those that extra cash. Now, by realizing every month, what this is going to do for you as a home buyer is you're going to increase your buying power. So with my example, the deduction would be about $520 a month and equal to an increase of buying power of $95,000. So if I could tell you get an increase of $95,000 by amending your W-4 with your employer, make a huge difference in what you can receive in homeownership. Now, also, I want to talk about the renting versus homeownership. If we're looking at $2,200 mortgage payment after the tax deduction, the homeowner would net. It would be a net out to closer to about $1,700 a month if you're able to realize the deduction of homeownership. Again, consulting with a licensed CPA, depending on how you're filing your taxes. Now, this does not count the almost $600 towards principal for the first month. That's just an additional benefit. I like to call it a home savings account, money that you might have access to when you sell your property as long as your property does not depreciate. Now, the equity potential and the security of the fixed payment is another benefit. So we've got a fixed mortgage payment for 30 years. Not counting taxes and insurance, your property taxes can go up. They'll actually go down if the property depreciates or depreciates. It'll go up if the property appreciates. Also, insurance for your homeowner's insurance can adjust as well. Now, a lot of people don't really take this into consideration. So if you're renting and your rent payment only increased, let's just say with inflation estimated at 3%, a $1,700 rent payment the next year would increase to $1,750. Over 30 years, you'd be paying over $4,200 a month in rent with no end in sight. So it went from $1,700, 30 years later, $4,200, and you're going to continue to pay that with that increase in inflation. Versus if you have purchased a home, the payment would have remained the same. The mortgage payment would stay the same as long as you're a 30-year fixed rate mortgage. And at the end of the 30 years, you'd be mortgage free versus having to continue to pay that rent. So the risk of renting is the possibility of not being able to continue to afford to pay the rent payment with inflation. And again, the no end in sight with mortgage, being able to see that you've got a roof over your head, not having to pay for it outside of taxes and insurance. Now, another ownership of tax advantage for home ownership is when you sell your home up to $250,000 if you are single, or $500,000 if you're married. In profits are exempt from taxation. Now, any amount over those thresholds is taxed at capital gain rates. Historically, capital gain rates have been substantially less than tax rates on ordinary income. When you leave an apartment, no tax will be due, but you will also not have a profit, which I think it's kind of nice with this investment like any other asset class investment. You can really look at the appreciation of your home is just as an added benefit. As you can tell, I believe in home ownership, and there's a lot of benefit to getting into home ownership, and why I'm excited for a conversation that we'll have with our guest here today. Coming up next in the Money Hour, what's coming up for the new year with real estate? Well, I've got Mathew Gardner, Chief Economist with Windermere Services, right here on 1150 AM KK and W after this short break.
This is Nnamdi Asamoah. I play football for the Philadelphia Eagles, but what I do off the field with United Way might be more important. I'm a volunteer tutor and mentor. Why? Because over 1 million kids a year drop out of school, and that's not okay. It takes 12 years to create a graduate, but it takes about the same time to create a dropout. And the difference between a child becoming one or the other could be me, or it could be you. Studies show that if we get to these kids earlier, their chances are better. And kids who read well by 3rd grade are more likely to graduate. So join me in United Way. Suit up and take the pledge. Become a volunteer reader, tutor, or mentor. Because when a child succeeds, we all succeed. Give, advocate, volunteer, live united. Take the pledge at unitedway.org. Brought to you by United Way, the Ad Council, and the National Football League.
My name is Tom Thornton.
And my name is Cindy Thornton. We're retired, and this is how we live united.
We decided to volunteer with United Way at our community free health clinic.
United Way is how we contribute, because we know our time and money are going to the right places.
Judging by the thank yous we get at the clinic, I'd say we're doing the right thing with our retirement, too. We're Tom and Cindy Thornton. We volunteer at our community free health clinic. We don't just wear the shirt.
We live it.
Give, advocate, volunteer, live united. Go to liveunited.org. Brought to you by United Way and the Ad Council.
This is the Money Hour with your host, Tina Mitchell, on Alternative Talk, AM 1150. Now, back to the show with local mortgage and finance expert, Tina Mitchell.
Welcome back to the Money Hour with your host and mortgage expert, Tina Mitchell, right here on 1150 AM KKNW, the Saturday 26 show. I'm empowering our community, providing you with opportunities and solutions when it comes to your money. If you're hearing my show at a different time or day, you are listening to a rebroadcast, but you can always call the show at 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com. And in studio right now, very excited to have a conversation with Mathew Gardner, Chief Economist with Windermere Services. And we're going to talk about the real estate market for 2016. Mathew, I am so excited to have you across the desk from me and in studio and the conversation that we're going to have. So thank you so much.
Oh, you're more than welcome. Delighted to be here.
Thank you. And a little bit about Mathew. As Chief Economist for Windermere Services Company, Mathew is responsible for analyzing and interpreting economic data and its impact on the real estate market on both a local and a national level. He has over 25 years of professional experience both in the U.S. and the U.K. Mathew chairs the Board of Trustees at Runstad Center for Real Estate Research at the University of Washington, sits on the Urban Land Institute's Technical Assistance Panel, is an advisory board member for the Runstad Center for Real Estate Studies at the University of Washington, where he also lectures in real estate forecasting. So Mathew, let's go ahead and just get started and get right to no market works totally independently. What should we expect from the U.S. housing market in 2016? Drum roll.
That's a great question. I think next year it's going to be a modestly improving year. And when I say improving, I think we'll actually see more transactions. One thing's been missing a lot in this recovery, actually total number of sales. So I think we will see a slight increase. It won't be the amount that we need, but it will go up a little bit. In terms of prices, I mean, we're going to appreciate next year. We'll likely not appreciate at the same rate we saw this year. Okay. I'm okay with that.
Yes.
I think we're probably
Things have got to balance out, right?
Exactly. Mm-hmm. So I think we're probably going to come in across the country at price growth of about 4.7, 4.8%. Okay. So less than we saw this year, but still, it's a positive. Looking out on the horizon, really, quite frankly, nothing is scaring me. The biggest issue we have right now is inventory and the lack thereof.
Yes.
Far more buyers than we have sellers. It's not just in Seattle. It's not just up and down the West Coast. It's really across the country.
So what do you, how do you think that's going to, you're going to see that improve, or are we for 2016, Mathew? Do you see our inventory getting any better for our buyers?
Yeah, and I think it will. There's for a couple of reasons. Firstly, we're seeing an increased amount of equity that people are now recovering, getting back the equity that they lost.
Okay.
A lot of things that what's holding people off from selling is the fact that they need to build up that equity or get at least recover it, the amount that they lost back in the recession, get above water, and then I think they have the ability to sell. So I think we'll continue to see that. In addition, we're also going to see some downsizing. Mm-hmm. A lot of us are out there who are getting older. We're looking to downsize. I think that is going to have an effect on the market as well.
Exciting.
But we kind of are stuck in a bit of a chicken and egg situation. Mm-hmm. What I mean by that is that we've got people that want to sell, but they're not going to list their homes for sale until they find somewhere they want to buy.
Yes, and when they're concerned about,
if they can't find somewhere they want to buy, they're not going to list.
Yes.
So you kind of get in this chicken and egg. But I think we'll see some improvement. I think sales will probably run up a little bit to probably just over 5.5 million units. In existing home sales next year. I think new construction is going to be the big story, though.
Okay.
We're going to start building, which is something we have not seen.
Yes.
So I expect to see new home starts and sales really jump quite dramatically. That's going to help with some of the pent-up demand there is out there.
Exciting. So interest rates are on the rise, as everybody knows. Are you worried about this, Matthew?
I'm really not.
Okay.
I think it's so much right now, it's a non-story. I spent a lot of time the last couple of weeks, obviously because of the Fed announcement that the Fed funds rate was going up.
You've probably been really busy getting around and sharing the news.
Yeah, and really the biggest problem is that everyone thought that the two things, the Fed funds rate was intrinsically linked to mortgage rates.
Yes.
It's not.
Where we saw mortgage rates go down.
Absolutely right.
Yes.
And so I think that a lot of people did get worried in kind of chicken little mentality. Certainly it's important. It's an important rate to watch. And actually it demonstrates an economy that is improving.
Yes.
And so that's actually a good thing. You have to lift interest rates above zero, certainly in the Fed funds rate. So that's going to go up. We will see a modest uptick in mortgage rates. I'm expecting probably a 50 to 60 basis point, i.e. roughly 0.5% up by the end of next year on the 30-year fixed. So that 30-year fix is still going to end the year well below 5%.
Yeah.
So I think the biggest concern that I have is a psychological barrier.
Yes.
And what I mean by that is that people have for the last year or so been quite happy with mortgage rates that started with a 3. And now they're saying, well, what do you mean we've got to pay more than 4%?
Yes. I know, isn't that crazy?
It's egregious.
Exactly.
And you have to stand back a little bit and look at where were they in 1990?
Yes.
Well, they were at 10%.
Yep.
And we still bought houses. Where were they in 1982?
Yes.
For those of you that remember, they were 20%.
Yeah.
And we still bought houses.
Yep.
So I think it really
And the
is
highest they've been when I was in the industry was 8.5 back in 2001, I think is when, so
Right.
it's crazy.
But quite frankly, I think what we're going to see is rates are going to trend up over the next couple of years, but I think they're going to plateau at around 6.5%. I just don't see them with the knowledge I have right now, with the way that it's tied to the 10-year Treasury, tied to the global economy.
Yes.
We're going to see interest rates really jump up much higher than that at any point in the future, certainly in the foreseeable future. So rates are going to go up. That's okay. They are still remarkably cheap from a historic perspective.
Got it. So, Matthew, there's a lot being said about the lack of home sale. Why is this, and what do you see changing?
As we just were talking about, I think we're going to see slightly increased amount of inventory in the marketplace. I think new construction will help a lot. We'll start to see a lot more starts. We can see the baby boomers who are going to start deciding they need to downsize. That's going to help. But we are still going to see some very tight markets. Unfortunately, the Pacific Northwest and Seattle is one of them.
Got it.
So I think that we'll probably see a slight increase in transactions, but we're still going to have inventory levels which are already at double-decade lows.
Yes.
Really not getting that much better next year.
So, Matthew, when you're talking about the appreciation maybe being 4.7, 4.8% for 2016, so slowing down a little bit, which is not bad, but do you feel that that we're at risk of having a bubble coming up? What are your thoughts there?
The bubble question, it's always coming up, and it's come up a lot right now.
Yes.
No, we're not. And I think when you look at it from the national standpoint, obviously when the housing bubble burst, it was a national bursting of a market which had just got silly. We're not in that situation right now. And why I don't worry about it is really very simple. The mortgage instruments that we saw back in 2003, 4, 5, which were really kind of the negative amortization option arms, these ridiculous things that were out there, they don't exist anymore.
Yep.
And that makes me very, very happy.
And you have to be qualified to get a mortgage.
And that's the big thing. Now you actually, believe it or not, you've got to have a job to get a mortgage.
Yes.
You didn't necessarily have to do that before on the no documentation loans and the like. So that means that we have got the ability to service that debt.
Okay.
And therefore the likelihood of seeing a massive meltdown in the mortgage markets in their entirety, very, very unlikely. That said, I think there are certain markets in the US which are getting a little bit ahead of themselves.
Okay, and which markets would those be? What markets are you concerned about?
I'm specifically looking at Denver, Dallas, San Francisco, and actually New York as ones which are growing in price at a very heady rate, and they're becoming increasingly unaffordable. And so I think that those are markets which, although will not necessarily collapse, will start seeing a slowdown greater than that we're seeing across the country as a whole.
Okay.
So they are getting a bit ahead of themselves, but again, not set up for a collapse.
So what are they, they always say that we follow like the San Francisco market. So does that mean if it does hit, they see a bubble, that it's going to follow and
not
we're
necessarily.
Seeing it next?
No, I mean, we are similar to them in some respects. However, our housing values are approximately 50%
Yes.
of that you see in the Bay Area.
Yeah, that's crazy. Yes.
So we have a kind of median sales price about $500,000, let's say, in King County.
Okay.
In San Francisco, it's just over $1 million.
Yeah.
So it's a big
Crazy.
discrepancy, and that's when you start having issues with affordability.
Okay.
I'm certainly not saying that King County locally is remarkably affordable. It's not.
Yes.
It is certainly very expensive, specifically for the first-time buyer. However, we're certainly not up in that 7-digit range
Got it.
that we're seeing down in Northern California.
Makes sense. So millennials, they haven't been buying. Do you see that changing?
The millennials, yeah, I think we will. It's so funny. The last year, I think we've been blaming the millennials for everything, from global warming on down to the collapse of the housing market. No, are they going to come back? I think they will, and here's why. That generation, basically born between 1980 and 2000, the older part of that generation are turning 30. So they are getting older. Now, they are starting their families later on in life, which is true, by about 1 or 2 years. So they're getting married later, having kids later, but they are looking to move out of those very expensive apartments, let's say in South Lake Union, and taking advantages of home ownership, as you talked about a bit earlier on, and creating families themselves. Now, when you look to do that, several things you're looking at, one of which is safety. Security is certainly very important. Schooling is remarkably important.
Yep.
You're not going to see these families raise their children in apartments.
Yes.
They are going to move out. So do they want to buy? Yes, they do. However, they've got a lot of obstacles ahead of them. Biggest one right now is student debt. They owe an awful lot of money on student loans. Look at student loans across the U.S., just federal student loans. It's about $1.3 trillion we owe on student loans that I anticipate in 20 years will actually get to $2.5 trillion.
My.
Now, some perspective on that, we owe about $890 billion on our credit cards. So we owe a third more on our student loans than we owe on our credit cards.
That's crazy.
And so it's a remarkable amount of money. And so it's hard for them. They're qualifying. It's still remarkably hard to qualify.
Yeah.
We've seen FICO scores on approved loans. The average FICO score on a denied loan, for a denied conventional loan last month, was 700.
Yeah, yes.
Very, very high. So we kind of went from the sublime to the ridiculous on the pendulum of 1 point, everyone qualifying.
Yes.
Secondly, no one qualifying.
Yeah.
So it's getting them to that credit rating, that credit quality, and also obviously down payments.
Yep.
That's hard for them as well. But when we see the mortgage, mortgage deductions are certainly remarkably important. Mortgage insurance premiums coming down.
Yes.
That's, again, very important as well.
And do you see some of it as just the education? Because you talk about down payment. I mean, there's so many different options out there. I think just people getting educated and understanding what's available are not missing out on the opportunity if they think they can't do it.
That's very true.
Yes.
I think, and certainly a lot of people that I speak to who are thinking about buying for the first time, they really are very uncertain as to how the process works.
Yes.
And much as I think there's a survey done fairly recently that says 75% of millennials wanted to buy, thought it would be the most astute financial investment they will ever make.
Yes.
But about 76% said they doubted they could qualify for a mortgage.
And I bet out of that 76% that probably maybe 25% couldn't. Just a guess. I don't know. But I hear so many people that come to me and that, well, I thought I needed 20% down, or, so that's a whole nother conversation there with you, Matthew. But I got to ask you, what keeps you up at night?
Several things. I think the
Oh, no, now I'm worried.
the biggest thing I think is us forgetting our past. Us getting back into the same issues that got us into the bursting the housing bubble in the first place. Repealing Dodd-Frank, for example, would be a horrible, horrible thing to have happen, because these are some of the controls which have been put in place that allow the mortgage markets to run efficiently, but also logically and sensibly. So I think those are the two biggest things that are out there. Credit control as well, as I mentioned earlier on. I think it's important, but we kind of got a bit ahead of ourselves in terms of how high the credit quality needed to be to get a mortgage. That needs to come down and still be at a logical level.
Sure.
You've still got to be able to afford to service that debt given your income. But right now it's still remarkably difficult. So that needs to come down a bit. If it doesn't, that's going to be a problem. But I think in all, we just need to make sure that banks are still the oversight is still there.
Yes.
And we are still saying, no, don't get back into the days we saw 10 years ago of ridiculous mortgage lending.
Makes total sense.
And silly mortgage lending instruments.
I got less than 60 seconds to go to commercial, but I got to give a shout out for Windermere in having you as part of the team and a chief economist. That is not usual for a real estate company to have a position like you. What put Windermere in that they made that decision to bring on that position?
Well, thank you. Yeah, it's We are the only traditional brokerage that actually has an economist in-house. I've had a relationship with Windermere since the late 1990s as a consultant. And I remember back in, I think it was 2010, the president of Windermere and I were talking about how could we have seen this better, i.e. the bursting the housing bubble.
Yeah.
And we talked. He said, well, perhaps you should do more for us. It took us about 5 years to get that right, but we did eventually. But I think what's important, certainly that ownership of Windermere Sea is we have about 6,500 agents. They need the information, they need the direction, they need to be able to advise their clients.
Yes.
And whether the market's going up or even if the market's going down, we're not going to tell them what they want to hear. I'll tell them what it's going to be.
Of course.
And I think that's just another tool we can offer our brokers across the 10 states where we're active.
Yeah.
And so I think it's a very it's an astute move, I think a very sensible move, and one certainly that so far the agents have been very, very happy with. And so I'm enjoying talking to as many as I can.
Yeah, that's
and
great.
answering their questions.
Well, I know they appreciate having you, definitely. Mathew, thank you so much for spending your time in here with me. I know that you're crazy busy and lots of conversations that you're having right now, so I appreciate your time.
You're very welcome. Thanks.
And coming up next in the Money Hour, today's real estate market for buyers and sellers, I have Tyler Freed with Windermere Real Estate right here at 1150 AM KKNW after this short break.
When I was little, I didn't talk for a long time. I liked things to always be the same. Anything new or different would scare and upset me. I was very sensitive to lights and sounds. It was almost like I had bigger eyes and ears than everyone else. So I built secret hiding places where nothing could get in. I didn't like looking people in the eye. It made me feel uncomfortable. I'd throw big tantrums over little things like when my socks didn't match. Sometimes I'd do the same things over and over. Until one day, I found out I had autism. My family got me help. Slowly, I learned how to live with it better.
You can see signs of autism in children as young as 18 months. Early intervention can make a lifetime of difference. Learn the signs at autismspeaks.org/signs. Brought to you by Autism Speaks and the Ad Council.
What is that?
Oh, it's my time machine.
Does it work?
Sure, just hit this button.
Whoa, dinosaurs, cool.
Or we can go here.
Hey, that's Napoleon.
Oui.
Or we can go to the future.
Wow, hey, you have this nice house. Do I have a nice house?
No, you didn't save any money, always spent it on vacations and stuff.
If only there was a way I could go back in time and correct that bad habit.
Yep.
Okay, the time machine is not real, but the saving thing is. Get in the habit of putting some of your money in savings each week through a 401k, savings account, or financial investments. Put away a few bucks, feel like $1 million. For free ideas and easy tips on saving, go to feedthepig.org. That's feedthepig.org.
What does this crazy little button do?
Wait, no!
This message brought to you by the American Institute of Certified Public Accountants and the Ad Council.
This is the Money Hour with your host, Tina Mitchell, on Alternative Talk, AM 1150. Now, back to the show with local mortgage and finance expert, Tina Mitchell.
Welcome back to the Money Hour with your host and mortgage expert, Tina Mitchell, right here at 1150 AM KKNW, the Saturday, December 26th show. I am dedicated to you, my listeners, providing you with the tools needed to make informed decisions on matters that affect your money. If you're hearing my show at a different time or day, you are listening to a rebroadcast to talk with the guests I have in studio or anything you'd like to share with me. You can call the show at 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com. And in studio right now, I'm going to have a conversation with Tyler Freed with Windermere Real Estate. It is the end of one year and beginning the new year. So talking about real estate and what's happening and what's coming up is really what the first two guests are. Tyler, thank you so much for coming back in studio again. It's been a little while since I've sat across from you.
Yeah, it's good to see you again, Tina. Thanks for having me in.
You're welcome. And to all my listeners, a little background about Tyler. Tyler, again, is with Windermere Real Estate. He's a second-generation realtor that has been selling homes for the last 11 years. He specializes in working with sellers and buyers relocating around the Puget Sound area. Tyler's family means everything to him. He has a beautiful wife that he met in college who now joined him in his real estate career. That's so exciting, Tyler. Soon to follow, maybe his very young. And how old is Carter?
He's going to be 3 March 30th.
Okay, so he's got a while before he'll join the family in real estate.
He's been going on some house tours already.
Yeah, that's awesome. Tyler, he's been on HGTV as featured Seattle real estate broker, hosted his own real estate talk show, which he invited and had me in studio as well, and has been featured on Zillow's 50 Agents, 50 States blog in 2014. In the past 5 years, Tyler has helped more than 200 buyers and sellers with their real estate needs in Seattle, Tacoma, and the Bellevue market. So if you're looking for an agent that will go the extra mile and one that is professionally dedicated to ensure every client is treated like a friend, then you will definitely want to reach out and give Tyler a call. You can reach him on the Money Hour site, or you can go to his site directly. And also, what he asks from his clients is just to give him 1% of your confidence and let him earn the rest. So please take time to read Tyler's past customer reviews. I mean, that's a big thing right now, Tyler, in reviews, and you've got some amazing ones out there. So I encourage all of you, my listeners, if you're thinking about real estate, to definitely read up on Tyler. So Tyler, let's get right into it, and let's start with what's happening in today's real estate market, kind of an extension conversation what we had from Mathew. And what did you see happen in the real estate market for this year, 2015? What did you see happen?
Well, we'll kind of touch on some stuff that Mathew talked about and take a little more of a local approach.
Okay.
I mean, the biggest thing is just how tight and little the decrease in inventory is. Kind of in the greater Seattle area, it's dropped about 15% in 2015. So that was a big thing this year.
And what do you think in the Seattle market has continued to flourish and see these high gains?
Well, Seattle's just continued to be really good, and Seattle and Tacoma actually both appreciated over 10% in 2015. So
wow.
I think a big reason Seattle's seeing that is just the high-paying jobs. They added, 45,700 jobs this year. So just an outstanding amount of jobs and kind of pumping into the economy and increasing prices there. And then a lot of these jobs, like we mentioned, are really high-paying tech jobs.
Mm-hmm.
And basic real estate fundamentals are there. People want to be close to the city for their commute. Not everybody wants to be stuck on the 405 all day long, getting home to the family. And the good walk scores and just the good area is a big part of it.
Yeah, it makes total sense. So advice, because you've worked with so many buyers and sellers, Tyler, what advice are you giving to your home buyers right now?
I think the biggest thing is, ask your friends and family for a referral for your realtor,
yes.
your lender, your home inspector. Those three really make a big difference in how the process goes, and it can go smooth or it can go poorly. So that's
yes.
kind of a big step there. And then always get pre-approved. It's the same talk we've had over the years of chatting about the real estate market. Inventory is tight. So if you're not ready to go, you're going to be missing out on that house, because we're still seeing a bunch of multiple offer situations all across the Puget Sound.
Yeah. So biggest advice is you've got to have that strong team. And if you have one glitch in that team, it can be a complete nightmare in the process. And I second that with Tyler, is make sure you get your recommendations. And I would follow the lead of your realtor, because they're the ones that are kind of overseeing the process, and they've got a person for every piece of that team in their mix that they can introduce you to. So I think that's a great way, once you find your realtor, to find the rest of the team that they work with. Now, Tyler, what about the strategies that you're sharing with your sellers that are looking at selling their home?
Well, much of the same for the buyers is definitely doing that research to make sure you've got the professional there. And, with rates, the possibility of rates jumping up, so making sure you're getting all that done and ready. And like Mathew talked about, there's a lot of people out there that want to make the purchase, but they have to sell their home first, so they're kind of tiptoeing back and forth on that. And with with your realtor, make sure that they're doing, that they have a stager, that they have professional photography, that they have the outlets to get your home in front of the most people possible, because not everybody does the same thing in this business.
Yeah, and I always say it's not about you selling your home, but it is about ultimately the price that you're going to get and the net proceeds you're going to walk away from. And that's really where the established and the experts are really going to be able to maximize your dollars. And, also on the price side of it, because I know there's still a lot of realtors. I mean, we know the 80-20 rule. I'm a believer that there's the 1%ers in the industry that really are killing it out there. And that's, really what I try to bring into studio is the elite of the elite, the best of the best. And there's a lot of agents that are putting prices on home or giving advice of what they can get for the home that are not accurate. So what are you telling your clients with that the risk of listing your home at the wrong price or listening for someone that says they can get a price that they really most likely can't?
Unfortunately, that goes a lot.
Yeah.
That happens a lot. But I mean, the biggest thing is getting a price, looking at the comps in the neighborhood, what's sold. Don't try and go 10, 15% above that. I know we have some crazy markets, but just making sure you've got it priced right. And a strategy I'm using right now with sellers is waiting till day 6. We have some experts with Windermere that did some searches, and they found that the highest price you can get for a home is on day 6. So
really interesting.
Yeah, so that's when we're reviewing offers for our new listings that we're having hit the market.
So there is a lot of strategies. That's just like one little tiny strategy, and the importance of working with an industry leader, without a doubt. So 2016, the hot markets, Tyler, what do you see as our hot markets?
Well, I think we're going to continue to see the urban sprawl. So we're going to see people still priced out of Seattle. I mean, there's always going to be people that have the money to purchase there, but people are making moves out to Shoreline and moves out to Edmonds, and then kind of down south. I think if you're close to the Sound Transit,
yes.
The Auburn market kind of shocked a lot of people. It's up over 10% this year in 2015. Kent's doing really, really well. And for those people that are looking for homes on acreage, I've seen a lot of good deals still down in Spanaway. And also Puyallup been really good. And I think those areas do well because it's got the fundamentals. The schools are really good. The safety that Matt touched on there, and easy access to where you work.
Yeah, and I have Sound Transit in here probably a few times a year, representation, and with all the stuff that's coming up, I know we've got quite a few years ahead of us before we're going to see all of these benefits. But it'll be interesting what happens in the South End market when our transportation does what they're planning for our future. So that'll be interesting and very exciting for us. So when do you feel is the best time to put your home on the market? I'm sure you get a lot of sellers asking this question right now.
Well, the short answer is once you have the equity and you're ready to go. But I think the biggest thing is everyone's waiting for the flowers to bloom and the lawn to look great and wanting to put it on in March. But the problem is everyone's thinking that. Same thing for buyers, too, when they start their search up. So real estate's all about competition. So if you have less competition, that's the time you want to have the home on the market. You don't want you want your neighbors to not be listing and be kind of the only house out there on the market, and that'll bring you the multiple offer situation.
Makes sense. So any other thoughts that you have in next year for real estate, Tyler?
Well, Zillow predicts that prices are going to rise 5.6% next year in the Seattle area. I think we'll see them up a little bit more. Definitely not the double-digit appreciation, but like Mathew touched on, the bubble's not really in sight, and the appreciation and the strong local economy is still driving it. So I think it's going to be another really good year.
Yeah.
And we've already seen new construction take off a little bit with D.R. Horton's just buying a ton of stuff, and Mainview Homes, they're doing really well around the area. So I think that's going to be a big factor, and that might actually be a little bit of competition for resale coming up in 16.
Yeah, and I will have to have an expert in to talk about the difference between resale and new construction. That just reminded me it's been a little while, because that's good information to share. So you have had so much success in your career, Tyler. What would you say sets you apart from a traditional realtor?
I think the agents that I see have success are people that have a ton of contacts. So being the millennial age that I am, it's social media, getting the house in front of a bunch of people, and taking that approach of being a teacher and not trying to be a salesman, just explaining what to expect. to make it smooth and then generate referrals and go from there.
Yeah. Now, going back to the sellers, with the sellers, it being everything kind of being stacked on their side, definitely being a seller's market in anticipation, unless we get a lot more inventory, it will continue to do that. But still, there's mistakes that are made out there from sellers. What do you see the biggest mistake is for a seller to be aware of?
It's definitely pricing.
Yep.
I mean, we're still seeing that a lot where people are just trying to push it too much on the price side. So, like we said earlier, just go off of the comps in the neighborhood, make your adjustments slightly and price it right.
And on the buyer side, for all of the buyers getting ready to start in the new year and get back there in the market, what would you say is the biggest mistake for a buyer? I mean, you mentioned a few of them, having the strong team, making sure that they're pre-approved, which they can't even make a mistake and not get an offer accepted because they're not pre-approved. Anything else that you would be cautioning for buyers as they're getting ready in the new year?
Yeah. Like we talked about, having your ducks in a row and making sure everything's good there with the financing end of it and not stretching yourself too thin. There are a bunch of amazing programs right now for people to get into houses. So look into that, explore some options, talk to a couple lenders, and really get to know these neighborhoods. And if you're not too far from work and you're surrounded by good schools, you're going to have a winning recipe to succeed and have your home appreciate.
Yeah, and that's great advice, as we were, talking with Mathew as well, that, just people finding out what their options are. And the first step really is to talk about financing. And the numbers are going to tell you that you can do it or you can't do it. And if you can't do it, you've got a plan to move forward. But the worst mistake that you can make is not get the information and see that there might be an opportunity for you. Now, in Money Chat, Tyler, I had talked about the benefit of homeownership versus renting. What other things are you advising for renters to get out there and take advantage of homeownership?
Well, it's like you could put a big sign up and say, hey, now's the time. Matthew and I were talking earlier, and rates might get up, 1%, and every percent they increase, that takes away 10% of your buying power there. So I think it's only going to get more expensive from the signs that I'm seeing. So continue to be in that cat and mouse game of trying to keep up with the rental, or put yourself in a position for appreciation in home ownership.
Yeah. So any strategies and things that you're doing to prepare for the new year, things that you might be doing differently in 2016 that you did in 2015 to adjust to our new year, or no?
Well, we're going to be teaching a lot of first-time home buyer classes and doing the education part to bring those renters into the buying pool. So we're going to continue with that and go after the online buyers out there and show them what's happening out there.
That's great. Tyler, thank you so much for coming back in studio. Always a pleasure, and Happy New Year to you. And I'll look forward to talking with you again in 2016.
Sounds great, Tina. Thanks again.
Coming up next in the Money Hour, how do you invest in real estate using your retirement dollars? Well, I've got Christopher Orr with Pensco Trust right here at 1150 AM KKNW after this short break.
It may be hard to believe, but people just like you are already saving money. FeedThePig.org makes it easy. Their simple savings plan teaches you how to start saving without going overboard, so you don't need to mooch off your friends.
You gonna finish that grape?
You mean the one in my mouth?
You don't need to stop buying the necessities.
What you're smelling is a natural musk.
Ew.
You don't need to be a medical test subject.
How do you feel?
Mostly okay. Sometimes, though.
You don't need to get a second job as a stuntman.
We need a new stuntman. Let's break for lunch.
You just need an internet connection. Don't get left behind. Start your personal savings plan with the tips and tools on feedthepig.org. That way, you don't need to sell your soul to the devil.
$15 is the best I can do.
All right, deal.
Brought to you by the American Institute of CPAs and the Ad Council.
Do you know someone in need of a free wheelchair ramp? The Master Builders Association would like to help. For 23 years, local residential builders have built free wheelchair ramps for disabled homeowners in King and Snohomish counties through Rampathon. If someone you know needs help with access to their home, please visit rampathon.org and complete an application, or call 1-800-522-2209. Applications are being accepted now through February 26th.
It may be hard to believe, but people just like you are already saving money. FeedThePig.org makes it easy. Their simple savings plan teaches you how to start saving without going overboard. So you don't need to start foraging wild berries.
I was skeptical, but these are actually pretty good.
You don't need to sell your soul to the devil.
$15 is the best I can do.
You just need FeedThePig.org. Don't get left behind. Get tips and tools at FeedThePig.org. Brought to you by the American Institute of CPAs and the Ad Council.
This is the Money Hour with your host, Tina Mitchell, on Alternative Talk, AM 1150. Now, back to the show with local mortgage and finance expert, Tina Mitchell.
Welcome back to the Money Hour with your host and mortgage expert, Tina Mitchell, right here on 1150 AM KKNW, the Saturday, December 26th show. My goal is to keep you up to date on the latest news and trends in our local economy. Keep me tuned in and I will keep you informed. If you're hearing my show at a different time or day, you are listening to a rebroadcast. You can call the show at 1-855-400-1150. Again, that's 1-855-400-1150 or online at themoneyhour.com to discuss anything regarding money or to talk with the guests that I have in studio. And I have on the phone today a special guest, Christopher Orr with Pensco Trust, and we're going to be having a conversation about investing in real estate with your retirement. Christopher, thank you so much for joining my show today.
Thank you for having me, Tina. Happy to be here.
And a little bit about Christopher. Christopher is Director, Institutional Products at Pensco since 2010 and was former financial advisor with Ameritrade. He holds his Series 7 and Series 66 licenses and is graduated of California State University in Long Beach. It'll be an interesting conversation for my listeners with the guests I have here today, talking about real estate with investing with your retirement dollars. So, Christopher, what are the advantages of using an IRA to invest in real estate?
Well, Tina, there's a handful of advantages. First of all, there's nothing like having a great cash positive investment in a tax qualified account like an IRA or a Roth IRA. But here at Pensco, we're firm believers in telling our clients and our potential clients that they should always invest in what they know and love. And real estate's something that everyone can relate to and everyone's familiar with and can see. Another great thing about investing in real estate is diversification. With the volatility in the market, a lot of people are over the 100-point swings every day and want to take, their retirement into their own hands and invest in something that they can control and take it off the market. So that's another reason that people really do find using their IRA to invest in real estate rewarding.
Mm-hmm. So what is the basic difference between a traditional and a Roth IRA, Christopher?
Sure. So anyone with an earned income who's younger than 70 and a half can contribute to a traditional IRA. Roth IRAs, however, have income restrictions. The other difference is that traditional IRAs are taxed after they're deposited, so you're taxed on the distributions, whereas Roths are taxed before they go into the account. And most times when when the money is coming out, there's no taxation then. So there's a tax difference and income contribution differences.
Okay. And what about the rules for investing your IRA into real estate?
Sure. So there's a couple things. Couple nuances, really. So there are prohibited transactions and disqualified parties, which we'll get into in a second. Mm-hmm. But otherwise, you can't buy from yourself or another prohibited person. You can't use IRA as collateral for a personal loan. Little things like the deed will be vested in the custodian's name. For example, if I were to buy a piece of property in my IRA here at Pensco, the deed would read Pensco Trust Company for the benefit of Christopher Orr. Instead of Christopher Orr outright. So the IRA is actually the owner of the investment for the benefit of the individual investor. Some other things, all the expenses and cash flows of that property would have to flow through the IRA. So again, because the IRA is the owner, all the rent that you're collecting or all the income that you're collecting from that piece of property flow back into the IRA. Same thing if you were to have an expense in the IRA, or expense in the property, the IRA would have to pay for that expense. And that, again, is because the IRA is the actual owner of record for the benefit of the client. So there's some little nuanced stuff like that.
It makes sense. So what you've mentioned, the prohibited transaction, what is that?
So there are prohibited transactions, and these are things that the IRS has deemed as either disqualified parties or actions that the IRS prohibits. And so something like self-dealing is one example. And this would be trying to buy your own house and then have your IRA purchase a house that you already own. So you can't buy from yourself.
That makes sense.
Or you couldn't buy your parents' house or your wife's house. There's things called commingling, where if your IRA is the record of owner and you start paying for the roof leak or a remodel or something with taxable dollars, you're commingling your taxable money with your qualified money. That's a prohibited transaction.
Okay, so go ahead, Christopher.
Yeah, there's also disqualified parties, and this is kind of in your family tree.
Okay.
You can't move up and down, right? So your parents, your children, your spouses, those are all disqualified parties. Those are going up and down the family tree. You can, however, go left to right. So siblings, aunts, uncles, nephews, nieces, those people would not be disqualified parties.
Interesting. So what about the type of real estate?
So we have tons of real estate here at Pensco, and our clients have invested in all different types, everything from raw land to rental income properties to manufactured homes to public storage units, trust deeds and secured notes, parking lots. We even have folks that own timber rights and mineral rights and cypress tree farms.
Wow.
So there's really a ton of options out there. It's a space where you can get really creative.
So what if my listener has an IRA and it doesn't have enough cash in it? What are there options for them?
Absolutely. So you can do a couple different things. You can always get a non-recourse loan if you're going to be the single owner on the property. And you can get a loan. The IRA would have a loan within it. You would pay that loan back as the property becomes cash positive and it starts bringing in income. You could also split down the property. So let's say your IRA wanted to own 50% of it and another investor wanted to own the other 50%. You could do that.
Okay.
You could wrap it into a private equity vehicle like an LLC or an LP, and then you could become a member of that LLC, and then that LLC would own the property. So there's a couple different ways to do it. Which makes, it's nice to have options like that.
Yeah, and I would imagine there might be some risks attached to using leverage. What would those be, Christopher?
Yeah, there are. Like everything, you got to do your due diligence, and everything comes with its risk reward. With the non-recourse lending and getting leverage in the account, you do have to be aware of unrelated debt financed income that could be subject to tax in the property. You could, obviously you could default on the loan and then your IRA loses the investment outright. That's a risk. You want to make sure that property is cash positive, because once you take that loan out, the loan is in the IRA. And again, that IRA has to make those loan payments. So if you spend all your retirement dollars to buy this house and you find no one to rent it to, and now your IRA can't make those loan payments, then you're at risk of defaulting and losing the investment.
Got it.
So always good to be cash positive.
Yeah, so just like anything else, just really understanding what all your options are, and just as you said, benefit and risk. Now, what about the real estate expenses, and how do those work?
Sure. So again, everything has to flow through the account.
Yep.
So let's say you hire a carpenter to fix the floor or get a new water heater or whatever that may be. You're going to send the request to Pensco or to your custodian of choice, and then we're going to cut the check or send the wire or make the payment for said services. Just like when the rental incomes, the check every month is going to be sent to your property manager or straight to us, and that rent check is going to get deposited into the account. So your account is collecting this rent every month, and when expenses come out, the checks get cut out of that cash balance.
Got it. So you've got to just really make sure that you're setting this up correctly and having the cash flow, as you said.
Absolutely. And it's always really smart to have that extra cash on hand, even when you first make the purchase, because unexpected costs always come up, right?
Of course.
And so you want to make sure you're not putting yourself in a hard place by not having the capital to cover any unexpected things.
Yeah. Now, can you talk a little bit about structuring the transaction?
Yeah, so again, you can have a direct purchase, which we talked about earlier, where Pensco Trust, for the benefit of the client, would be the owner of record on the deed. You could have partnering IRAs or partners in general, so 50% owned by me, 50% owned by my partner, and those could both be IRAs. You can do using leverage again with the non-recourse loans. You could wrap it up in an LLC. You can do secured mortgage deed notes, so someone who maybe couldn't get a line of credit before, you want to give them a loan and you use their house as collateral. So there's a lot of interesting things that you can do.
Sounds like it's really creative options.
Definitely. And again, we really want to stress that people invest in what they know, and if the real estate sector is something you're familiar with, and it's almost a no-brainer out there with the craze of the market these days.
Sure. So I've got just about a minute. I've got to wrap up the show here, Christopher. What do you want to leave my listeners with when it comes to using your retirement to possibly purchase real estate?
Well, like we said, the options are almost limitless, and they're out there, and Pensco's here to make it possible for you. So follow what you want to invest in, take control of your destiny, and when you're ready to take some action, we're here to help.
Christopher, thank you so much for taking time to be on the show with me. It's been a pleasure having a conversation with you.
All right, Tina, thank you so much for having me, and have a good one.
You too. This is your host and mortgage expert, Tina Mitchell, signing off for the day. Enjoy the rest of your Saturday, and I look forward to talking with you more money conversation as we get into the new year. Same time, same place, right here at 1150 AM, KKNW.
The preceding program is paid for by Absolute Mortgage, a division of Finance of America Mortgage LLC, Equal Housing Lender, NMLS 1071, AZBK 0910184. Tina Mitchell, MLO 145420, is a licensed loan originator with Absolute Mortgage. Visit AbsoluteLoans.com or call 888-90-HOMES for cost information.